Hi all. Good evening and welcome. I'm Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on unsecured lending, opportunity for growth or looming risk. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Ms. Presha Paragash, Wholetime Director and Chief Executive Officer, Kisetsu Saison Finance India Private Limited, Mr. Ashish Goyal, Co-founder and Chief Financial Officer, Earlysalary Services Private Limited, and Mr. Hemang Mehta, Chief Risk Officer, Vivriti Capital. This session will be moderated by Sanjay Agarwal, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Nikhil Hardikar, Associate Director, CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of any queries, participants are requested to key in your panel. We will take up all your queries during a panel discussion. Now, may I invite Nikhil to make his presentation, please?
Thanks, Divya, and good evening, everybody. Welcome once again to CareEdge Ratings webinar on unsecured lending, opportunity for growth or looming risk, a topic which has been in focus as various stakeholders have been highlighting relatively high growth in this segment and concerns relating to high growth. The major takeaways from today's presentation are as follows. Retail credit grew at almost 1.5 times the overall credit growth of banks and NBFCs during the period FY17 to FY23. Within retail, the unsecured retail loan growth has outpaced the growth in overall retail book and now accounts for almost one-third of total retail loans. NBFCs lead in origination volumes, with average ticket size witnessing continuous decline as they shift focus towards smaller ticket size loans. High growth in unsecured retail loans is driven by multitude of factors. Some of these factors are structural in nature, and hence going forward, relatively higher growth rate is likely to continue. Asset quality has remained relatively stable. However, it requires close monitoring on small ticket size loans. Lastly, with each of the player focusing on certain subsegments, credit behavior of unsecured retail portfolio of the players are likely to display divergent trends in terms of asset quality and credit cost. Now let us look at the overall credit industry and market size for retail. As seen from the chart on the left, the overall credit combined for banks and NBFCs saw a CAGR of 12% during FY17 to FY23 and stood at 170 lakh crores as of March 23. During the same period, the retail loan book growth stood higher with a CAGR of 19%, as can be seen from the chart on the right-hand side of this slide. In absolute terms, retail credit by banks and NBFCs has almost tripled in past 6 years and stood at 52 lakh crores, forming 30% of the overall loan book as of 31st March 2023. Moving on to the topic at hand, this slide depicts the growth of unsecured retail loans in banks from March 17 to March 23. Unsecured loans in this chart include credit card receivables, consumer durable loans, and other personal loans. The cyan-colored bars represent the total unsecured retail loans in banks measured in rupees lakh crores, while the blue line corresponds to the growth percentage, which is plotted on the secondary axis. As can be seen from the chart, unsecured retail loan growth stood at a CAGR of 21% and has outpaced the retail loan growth, which exhibited CAGR of 19% over the period FY17 to FY23. Consequently, unsecured retail now accounts for almost one-third of the overall bank's retail credit. Now let's have a look at the factors driving this growth in the following slide. On this slide, we have shown the key drivers for unsecured retail loan growth, and broadly there are 8 factors. Favorable demographics marked by increasing younger population along with changing attitude towards credit, formalization of the economy, higher purchasing power, evolution and rise of fintechs, penetration of internet and feature phones, use of digital payments, advent of India Stack and leveraging of information collateral, and higher coverage of credit bureaus. One of the reasons, as we saw in the previous slide, is the availability of data on credit behavior of an individual, which then feeds into the credit engine of banks, NBFCs, and fintechs. The increase in coverage under credit bureau enables credit responsible behavior. At the same time, increase in Aadhaar coverage enables easier biometric identification. Initiatives like India Stack, which refers to the unified software platform to enable presence-less, paperless, and cashless service delivery, are acting as catalyst in accelerating the digital adoption for credit delivery. From a demand side, while disposable incomes are rising, discretionary as well as non-discretionary spending have outpaced the income growth. And as a result, the household savings have fallen from around 17 lakh crores or 7.2% of GDP in 22 to 14 lakh crores or around 5.1% of GDP in 2023. As per the latest report by RBI, household savings in India hit a 47-year low at 5.1% of GDP in FY23. This was mainly on account of increase in household financial liabilities, indicating that people are becoming more dependent on borrowing to cover their consumption demands. The decline in household savings was witnessed especially post FY21 when pent-up demand from COVID-affected period leading to higher consumption. In the next few slides, we will be looking at some key trends witnessed in the unsecured retail loan segment. This slide gives lender type-wise origination volume in absolute terms as seen from the chart on the left-hand side and relative terms as seen from the chart on the right. From the chart on the left, we can clearly see that the borrower count has increased across lender segments. However, NBFCs have witnessed disproportionate and multifold increase in origination numbers. Likewise, if we look at the chart on the right, there was a dip in volume share in the first year of COVID, post which NBFCs witnessed a sharp recovery in volumes in the subsequent years and is estimated to account for 78% of loan originations by volume in FY23. As we'll see in subsequent slides, small ticket loans have led to higher volumes, and such segment is typically covered by NBFCs and fintech NBFCs. Now, having looked at the originations in volume terms, let's eyeball the originations in value terms. The chart on the left-hand side shows lender type-wise origination value in absolute terms, which depicts an increasing trend and more so in the past 2 years. The origination value of unsecured retail loans witnessed a CAGR of over 45% post-COVID, that is from FY21 to FY23, and 30% CAGR if we calculate it for the period FY17 to FY23. Another observation from the chart on the left is that post-COVID, PSU banks have grown faster than both private banks and NBFCs. Increase in origination volumes of NBFCs has led to steady increase in value market share in loan originations of NBFCs, except for dip in the first year of COVID-19 pandemic, which is depicted in the chart on your right-hand side. However, it may be noted that despite lower share of origination volume, origination value share is still dominated by banks owing to the higher ticket size loans catered to by them. The same is discussed in the following slide. So this slide highlights the average loan ticket size of originations catered to by different lender categories. NBFCs have focused on providing small ticket size loans, especially with the evolution of fintechs, which focus on younger and new to credit population. As a result, it has led to a steady decline in the average ticket size of loans catered to by them. As seen from the chart, the median operating zone for NBFCs is somewhere in the range of 25,000 to 30,000, while that of private banks is around 2 lakhs and public sector banks is even higher at 4.5 lakhs as estimated for FY23. Private sector banks have also witnessed a decline in average ticket size over the years, with significant amount of fresh lending on low ticket sizes, a large part of which is supported by fintech-led originations. On the other hand, it is pertinent to note that the PSBs have witnessed growth in average origination ticket size during the same period. Continuing with the key trends, as we see in the chart on left-hand side, which gives origination ticket size-wise data in volume terms, it can be observed that less than 1 lakh ticket size loans account for lion's share, supporting the analysis that rapid granularization has taken place in recent times. Ticket size of less than 1 lakh accounted for 85% of volume, which is up from 40% in 2017. Within this bucket, loans less than 50,000 accounted for almost 80% of the volume. However, it can also be seen from the chart on the right that share of such loans in value terms account for only 11.6%. In terms of value, the share of greater than 5 lakh loans has been on an increasing trend, accounting for more than half of the total loan origination by value. As we dig deeper and look at split of origination value in two categories, namely below 50,000 and above 50,000, for Q3 FY21, Q3 FY22, and Q3 FY23, we see that the composition of loans below 50,000 have exhibited increase in value share, increasing from 5.3% in Q3 FY21 to 7.4% in Q3 FY23. As seen from the chart on the right-hand side, less than 50,000 loans account for major chunk in origination volume. There has been an increase in loan originations in less than 50,000 rupee loan category, accounting for 80.6% of total loan originations in Q3 FY23, as against 72.4% in Q3 FY21. Less than 50,000 rupee loan originations are predominantly catered by NBFCs and fintechs, which account for 87.1% of loan originations by volume in this particular segment. Having looked at the various portfolio cuts of the unsecured retail loan pool, in this slide, we highlight the distinct business strategies and financial models among different lender categories, with emphasis on varying yields as depicted in the left side chart and credit cost as depicted on the right side chart. Fintechs have created a niche for themselves and have experienced rapid growth, thanks in part to focus on smaller ticket sizes and extensive use of technology, which led to ease of borrowing. Fintech NBFCs predominantly cater to enabling funding for discretionary expenses among consumers seeking a lifestyle upgrade. Moreover, their focus on digital-first processes combined with user-friendly borrowing experience has enabled fintech NBFCs with ability to charge higher yields compared to traditional NBFCs and banks, as reflected in the chart on the left-hand side. However, as per CARE's estimate, based on the median values, fintech NBFCs also witness higher credit cost as compared to traditional NBFCs and banks, which is reflective of the higher risk category of the borrowers catered by them. As seen from the chart, sample set of NBFC fintechs have around 5% higher yields as compared to traditional NBFCs, while the credit costs are higher by around 8%. Given the target customer segment of NBFC fintechs, ability to reduce credit costs in the near term remains to be seen. In view of the same, achieving efficiencies, reduction in OPEX is critical to profitability. For a sector as a whole, with increasing share of fintechs, the movement in credit losses need to be closely monitored. Lending to any category of asset comes with inherent risk in the form of asset quality. The chart on the top left side illustrates the percentage of retail non-performing assets, excluding secured asset class of housing, auto, and education, and is plotted for three categories of banks, that is public sector bank, private banks, and aggregate, which is scheduled commercial banks. The data, which spans from March 16 to March 23, indicate that the trend for both public and private sector banks have shown a gradual decline in the percentage of NPAs over time. The chart on top right displays the percentage of below prime borrowers across different types of financial institutions. Below prime borrowers are defined as ones having bureau score of less than 730. As of FY23, the proportion of below prime borrowers has been declining over the past 3 years. The least exposure to below prime borrowers is seen in the case of private banks, while in case of public sector banks as well as NBFCs, it remains over 50%. However, across all lender categories, the overall share of below prime borrowers during the period FY21 to FY23 is declining. This suggests that efforts are being undertaken by the lenders to manage risk, and overall financial landscape is moving towards healthier lending practices. Continuing with the probe on asset quality, table on the left-hand side shows the early warning signals as measured by special mention account categories SMA 0, SMA 1, and SMA 2 across various lenders. The public sector banks exhibit higher SMA of 9.9% in unsecured retail advances as compared to 4% for private banks for unsecured retail loans category. At an aggregate level, banks have around 7% of their unsecured retail loans in the SMA 0, 1, and 2 categories. Interestingly, even the SMA share of secured retail advances also lie in the range of 7% as on 31st March 2023. The chart on the right is the transition matrix, which indicates the movement of borrowers from one bucket to another over the past 1 year, that is from FY22 to FY23. As an example, around 29% of borrowers in the subprime category in FY22 were upgraded to various buckets in FY23. So as per this data, the upgrades from lower category to higher category have been lesser as compared to the downgrades from higher category to lower category. But a disclaimer here is the proportion of people in each category to start with would be different, and hence the percentage upgrade or downgrade may not be strictly comparable across categories. However, as a proxy, if we look at the overall consumer risk distribution, including the share of secured retail asset class, the share of subprime as measured by scores below 680 is 24.2 in FY23, while that of superprime, that is scores between 791 to 900, is 5.8%. Coming to the performance of care-rated entities, the chart on top left depicts the AUM growth of these entities, which witnessed a CAGR of around 54% from FY19 to FY23, indicating the growing popularity of NBFC fintechs in the unsecured personal loan segment. The chart on the top right depicts the disbursement trend. The disbursements too have shown a similar growth trajectory from FY19 to FY23. Annual disbursement during FY23 stood about 25,000 crores compared to less than 5,000 crores in FY19. The credit cost of care-rated NBFC fintechs is highlighted in the bottom left side chart, and the same has witnessed an increase from 4.1% in FY19 to 9% in FY23. Increase in credit cost can be attributed to a combination of COVID-19 impact and some level of seasoning in the portfolio. In the pre-June 2023 era, where the fintechs used to extend default loss guarantee or DLG of more than 5% to the partner institutions, the credit costs were being absorbed in the fintech or the fintech's NBFC balance sheet, depending on which entity has extended the DLG. However, as discussed in earlier slides, at a consolidated level, high yields, processing fee, and spread over hurdle rate of partner institutions cover for fintech NBFCs high OPEX and high credit cost. Coming to the bottom right chart, it shows the profitability as measured by return on total assets or ROTA among care-rated NBFC fintechs. Despite continued high credit cost, ROTA turned positive for NBFC fintechs during FY23, deriving benefits of improved scale as tech and manpower costs get distributed over a larger base. Now coming to the outlook, Care Ratings believes that the growth of unsecured personal loan segment, especially small ticket size, is expected to continue in the immediate to near term as more players adopt technology to source and service the loans. Also backed by a multitude of factors as we have discussed in today's presentation. With regulatory clarity on the business model, especially on the default loss guarantee, disclosure norms, KYC norms, and fair practices, it will attract more players and capital to this segment. Increasing awareness of the stakeholders will improve credit quality by avoiding adverse selection and improving collection practices. However, attractive return rates for equity capital providers would critically hinge upon controlling credit cost and operating expenses. We now have come to the conclusion of the presentation. Now let's listen from industry experts. Thank you. And now I would like to hand it over to Divya for panel discussion.
Thank you, Nikhil. As conveyed, the attendees are requested to key in their questions, which we will take up during our panel discussion. May I now invite Sanjay Agarwal to take over the session, please. Sanjay Agarwal is the Senior Director at CareEdge Ratings. He has 3 decades of experience in the field of ratings, banking, and infrastructure finance. Currently, Sanjay is heading the BFSI vertical of Care Ratings Limited. Prior to joining CareEdge, he has worked at ICICI Bank and IFCI. He has a bachelor's degree in commerce and is a chartered accountant. He has also qualified as a grad CWA, a financial risk manager from GARP USA, and is a certified financial planner from FPSB India. Over to you, Sanjay.
Thank you, Divya. Good evening to all the esteemed panelists and participants. It is with great pleasure that I extend a warm welcome to each and every one of you. And thank you, Nikhil, for the insightful and informational presentation that you have set the stage for our discussion. As highlighted in the presentation, the growth of unsecured personal loan in India has been a topic of significant interest amongst various stakeholders. And we hope that the knowledge shared today by the panelists will be enlightening and beneficial to all the participants and other stakeholders. We are honored to have three highly esteemed panelists joining us today, and I express heartfelt gratitude to each of them for generously sparing their valuable time to contribute to this panel discussion. Before we proceed, it is important to reiterate that the views expressed by our esteemed panelists represent the individual perspectives and may not necessarily reflect the official views of the institutions they are associated with it. I would like to quickly introduce our panel members to the webinar, and it is my privilege to briefly introduce each one of them. Our first panelist is Mrs. Presha Paragash, Wholetime Director and Chief Executive Officer of CareEdge Saison Finance India Private Limited. Presha holds an MBA from Wharton School and a BSc from London School of Economics. With over 15 years of experience in financial services sector, her role has spanned from investment banking during her tenure at the UBS in London office, where she was focused on M&A. Upon her return to India, she ventured into investing in seed startup and founded a fintech startup. Prisha has been integral to the Credit Saison India team for the last 5 years, playing a pivotal role in building and scaling the business. We extend a very warm welcome to Prisha. Our next panelist is Ashish Goyal, co-founder and CFO of Earlysalary Services Private Limited, also known as Vibe as the brand. Vibe has emerged as a key player in the digital commerce finance under Ashish's leadership. Previously, Ashish was Chief Investment Officer of Bajaj Allianz Life Insurance, where he managed a substantial portfolio worth over 50,000 crore rupees. Ashish is a chartered accountant renowned for his proficiency in various financial domains, including business finance, investment, treasury management, risk management, strategy initiatives. Ashish is a decorated fund manager. He was recognized as the most astute bond fund manager by Asset Magazine Singapore from 2011 to 2013. A very warm welcome, Ashish. Our third panelist is Mr. Hemang Mehta, Chief Risk Officer of Vivriti Capital. With over 20 years of corporate banking experience in diverse roles encompassing credit analysis, stress asset management, transaction banking, and relationship management, Hemang has been associated with banks such as Standard Chartered, HSBC, and ICICI Bank. His education qualification includes a Bachelor of Engineering in Chemical Engineering and Masters of Economics from BITS Pilani, along with an MBA from XLRI Jamshedpur. Again, a very warm welcome to Hemang Mehta. I extend a very warm welcome to all the participants who have dedicated their time to be a part of this webinar. In case any participant wants to ask any question on the presentation made or otherwise, they are requested to key in their question in the panel on the screen. Now we begin our panel discussion and simultaneously take questions from the participants. So I'll start with a question from Presha first. In the past few years, growth of unsecured personal loan has been relatively high. Are there any structural changes which are contributing to the growth in this segment?
Yeah. Hi. Good afternoon, Sanjay. Thanks for having me. So I think you also showed a slide, right, clearly articulating in terms of the growth factors. But I think it's really been a consumption-led growth that has really been driving this demand, right, over the last few years. But I think the fundamental point here, right, is that I think we also have to take a moment to acknowledge there has been a tremendous mind shift in the way the consumer is also thinking, and especially when it comes towards the younger demographics population as well. Now, if you look at it, I would say about 10, 15 years ago, probably taking a loan in order to purchase something would not really be at all top of the mind, right? But I think today the population feels that, those options are something that you want purely because you also feel that, you're in a good paying job. You can afford to pay for your EMIs, right? So those factors, help to enable why it's being a consumption-led economy. The younger demographics today is probably happier not committing to a home loan, probably okay renting a house. But at the same token, the aspirations of certain more needs and wants is what is probably fueling a lot of the demand as well. So I think while you have that on the demand, I think the advancement on how the whole process of taking a loan has also fundamentally changed over the last few years, right? Today, because of the the whole sort of digital stack that we have, taking a loan could not be more convenient as well, right? So the ability to get a loan in actually a few minutes, the flexibility of the loan that comes today, right? You can take it for 18 months, you can prepay, you can close it and everything as well. I think the product that is being tailored also that, is really catering towards this young population is also allowing it. So I think both this, combined together, a total mind shift of the younger sort of population who's looking to take it, driving more towards a consumption-led reason for it, along with the fact that, technology has really allowed it to be, really instant, much easier, convenient. The kind of products that have also come out of this, I would say, would be like the key enablers for this.
Okay, thanks, Prisha. So, yeah, the next question is to Ashish. So, as Prisha said, there has been a demographic change, mindset change. The process itself has become much more easier. We could also see factors driving loan growth were formalization and digitization and the Indian stack. So, with all this, how has the underwriting model evolved for over the years for the fintech industry?
So I agree with Prasha on how the demographics are changing and leading this entire growth. Also, the mindshare both not only of the borrowers or of the people who are looking for money, as well as the people who are lending. The lenders' mindset has also changed over last 10 years about how do they look at lending the money. And that gets formulated by scorecards, that get formulated by how do we really look at the customers from credit lending perspective. Last 10 years has really been about cultural shift in India, where people have started thinking about consumption as a way of as a one part of their life, unlike what it was there 10 years previous to a decade before, and which also has enabled us to have a lot of rich data about the consumers. Today, the ability of the consumer data available through bureaus, through mobile applications, through various initiatives has really enabled us to build scorecards on the fly. Today, our ability to process the data using the latest technologies has allowed us to ensure that we are able to underwrite the customer frictionless. But the most important part is that the underwriting model itself has evolved over a period of time. Our ability to change those models has improved, and the CIBIL has played a big part, as well as Aadhaar, Jandhan has created an opportunity for us to provide that digital infrastructure. Today, the underwriting models for most of the unsecured loans has moved away from a physical paperwork to the underwriting scorecards. And I'm not talking just about fintechs. I think that has happened across the industry, whether we talk about banks, whether we talk about even the private public sector banks, has started building the scorecards around it. So in my mind, the scorecards are not going to be the just having a scorecard is not the differentiator. How do you really look at the same data differently and provide an opportunity to service the customers differently will become a key change, and that is where the fintechs are leading the charge and looking at the data differently, and ability to slice and dice the customers and create segmentation. Like in your presentations, you have said that 78% of the loans are given by fintechs and which are smaller than 50,000 rupee loan. If you think of those loans, these loans cannot be given without building a digital experience, without building the scorecards which can differentiate the customer through various cuts and provide the right set of limits right sets of tenors while ensuring that your risk remain under control. So the scorecards is evolved completely. Ability to redeploy scorecards has also gone up. Like today, if you look at ourselves, we are able to redeploy a new scorecards for every segment in 6 to 9 months time, and we can continue to rebuild, and which allowed us to really change with time. Like take an example, about 3 years back, in a bank statement, you will see ATM withdrawals. Today, the ATM withdrawals has completely vanished from bank statements. It has all got replaced with UPI transactions, right? So our ability to look at those trends and change in the scorecards become very, very imperative. And ability to continue to monitor that scorecards has also become very, very clear. Like today, most of the times when you take a loan, or when you take a credit card, let's take a credit card as a good example. If you are paying on time, generally for 10 years also, they might not look at you and you will continue to enjoy the same lines. But given the kind of a data availability, ability to upgrade the customers or downgrade the customers has gone up significantly. So the scorecards as well as data analytics has played a big role in enabling us to provide the services at a friction, and also at a very, very low cost of executing the transaction. So I think the entire enabler of digital infrastructure, along with ability to build the analytics on the top of it, has enabled a lot of growth. As much as demand was there was also a supply meeting the demand.
Okay. So, Ashish, we had another related question. Since you touched upon the credit bureau evolution and all that, there's another question by one of participants that do you see any challenges with scores assigned by the credit bureau given the changing landscape of borrowers, loan size, and tenure?
That's an interesting question, Sanjay. And yesterday only I was chatting with one of the colleagues, and I think the credit bureau scores in my mind are a general sense of where the customer credit worthiness is, but still it is a very generic in nature, because the same credit score is used for personal loan, for home loan, for auto loan, for two-wheelers, etc. So it's very, very generalized sense of where it is going, like a trend. But taking a granular view and taking a credit decision based on just a credit bureau scores, in my mind, is not right. We need to build our own scorecards on the top of it. And the second thing which also is happening, and there is a data around it, that over the period, like which we call as super prime, the definitions of super prime is more or less static by the credit bureaus. But internally, many of us has started changing those definitions purely based on the whatever incoming information which we have. Like just to take an example, in the last 12 months, the approval rates across all the segments has started already dropping. While now we are the markets, everybody is talking about the overheating, but many of the lenders has already initiated taking actions on what they were seeing in their granular data. And so credit bureau scores are good from getting a general sense of idea, but most of us has built our own scorecards. We have built our own understanding of the consumers, which allowed us to do better, both from a giving right set of money to the consumers, as well as also to meet our targeted, let's say, credit cost.
Yeah, right. So, means in fact, in our discussion with the counterparties across banks and fintechs and other NBFCs, the one thing which comes out is that credit score generally gives you the past data, so that may not be reflective of how the conditions are evolving.
Yes.
Two, I think most of the participants had started remodeling the credit scorecards and increasing the rejection rates or reducing the approval rates, probably even sacrificing some margin in the case, because some of the fintech, even yours, I think there's a clear policy that you want to reduce the rate but reduce the credit cost significantly more than that.
Yes.
So I think that development has been very clear, and now obviously regulators have been
Yes.
making quite a few noises on it. So that was my question for Hemang, that is there really a cause of concern for regulator, as the regulators highlighted in the financial stability report? How do you see this from overall risk perspective? Is this high growth in unsecured loan a warning signal? What is your views?
See, definitely when you see some, area which is growing much faster than the rest of the market, that poses a question in terms of are we moving in the right direction? And to some extent, yes. But to flip it the other way, um, in terms of the credit culture, we are way behind other developed countries. While in our credit journey over the last 20 years, if you see, mortgages was also not a very big sector till 20 years back, and then that sector has evolved till 2010. We've seen a rapid growth in mortgages. In the last 5 to 10 years, we have seen a rapid growth on this side, on the personal loans. And this is in a way linked to the way Presha was explaining that there is a change in mindset. These small ticket loans are taken by a slightly youthful population. And this youthful population has just entered into a working age group. They've got their salaries, they've started getting financially independent, they started living away from their families. And in that sense, this is a demographic which is a big positive for India. So in that sense, I don't see this as a serious cause of concern, because in terms of the availability to finance, yes, it has dramatically increased. So it is not just that a blue collar or a white collar person is able to access this credit on a personal loan. These small ticket size loans are availed by even, say, a person who's starting off in an informal job like a driver or a Swiggy delivery agent. So in that sense, credit demand is widespread across the spectrum, right from a low income person to a middle income person. And in that sense, I think it is a big positive. So far, I don't see significant credit concerns given the levels of expected credit losses that we are seeing. Another big source of comfort is that the tenor for these loans is also not too long. So some of these loans range from 3-month loans to a maximum of 1 year or 2 year loans at best. So in that sense, we are seeing a churn. We are seeing customers repay, and then they are eligible for a higher ticket size. So far, I would not say that there are significant credit concerns, but we need to be watchful.
Okay, so Prisha said that borrowers are willing to borrow. Ashish said that lenders are willing to lend. And you say that there are not too many concerns. So I think we are in better days now. But still, I would like to ask Prisha that we saw in one slide that there is a fall in the net household savings attributable to increase in the financial liabilities. So does it convey that any risk is building in the system?
And I think, sorry, just maybe before that, right? I think one thing that's very important to also understand, within this unsecured personal loan side as well. I think it's also about on that there's also, as we saw in that slide, right? Like, for example, fintechs are lending at 25%, right? And then you showed, for example, that, credit costs say maybe a bit higher, 6-7%. In this unsecured PL, and especially in this smaller ticket size as well, there's also a good buffer to factor in credit costs, right? Now, of course, what is slightly alarming is when it's rising, how much of that spread and buffer do you have, right? That's the starting point. But the spread is quite large to start with, right? I think that's a very important point for us to acknowledge, that because there's a spread, this continuous evolvement is very important, right? Because then when we start seeing some risk building up, we pull back, right? We start tightening the policy and everything as well. But in cases where, if the margin of the spread is very small, that can be even more worrying overall as well, in terms of what kind of risk we can see building up for this whole unsecured lending overall, right? Now, definitely, household savings coming down, that's definitely an indicator that, definitely people are spending more and everything, right? Which I think is playing with the overall theme, as people believe that, you have a higher purchasing power and all. You believe that you're able to also start spending more, right? So I feel that, both are also quite interlinked in that sense.
Okay. So, but how do you see the savings rate itself? They're seeing the rate of financial liabilities is going up more than the saving rate. So, do you see that as a concern, or probably those are pockets which need to be monitored?
Yeah, I think it'll be a little bit more monitoring as well. I think we have to join it with, as we see, the customer that is borrowing, how many multiple loans also does he end up having, right? So I think you have to look at it both in tandem of that same customer. Okay, if a savings is kind of declining, right, and at the same token borrowing, how many multiple loans? Because then the thought is he really an over leveraged customer and everything? Because then it's not just delinquencies on the PL side, right? Because once you're an NPA on PL, you will sort of be NPA across all the accounts and all as well, right? So that can also see more of a build-up. But I think what is quite important is that, that's why data plays quite an important thing in our lending as well, right? Because when, for example, when we get like SMS data and everything, you can also see, how much average bank balance is he maintaining, right? Does he sort of have anything where there's a buffer, or, he's, living month on month and everything? Those are also good indicators to correlate in terms of what is he saving. Then that customer, if that customer has a very low, is he bouncing? Is he becoming more of a bad customer? So I think using that is also very important in terms of how you underwrite better certain of these customer segments as well.
Okay. So there's one question I'd like to ask Ashish, since he's in Pune and there are a lot of technology firms out there. So while there's a lot of noise on STPL, do we see risk building up in the large ticket loans as well, especially for the IT sector loans where we are seeing a job slow down? How is the situation evolving there?
So I'll just take a step back. I think one which is happening is that there is again going back to the same point, that there is a mindset shift in the today's borrower versus the borrowers which we had 15 years back. And that can be reasons by many factors, like say the resource scarcity which we had 15 years, 20 years back, or let's say 90s, which at least many of us has lived through the balance of payment crisis, etc. And we have seen, and we became little bit more conservative and saving oriented in compared to the overall world. If you look at it, the country has become much more ambitious, country has become much more, people have become much more independent, nuclear. The savings tends to go down purely because your ability to predict your incomes has gone up significantly than what it was 20 years back. Like today, many of the salaried people has an ability to predict that even if they don't rise, they have their confidence and ability to predict their incomes for quite a few years is there. So that is also, these are the cultural factors and the structural factors which are also leading to a drop in savings rate and increase in some kind of a borrowing behavior. The second, I think generally what we are seeing, and there is a phenomena which last 1 year, if I try to put your question differently, that we are seeing average ticket sizes are going up across the segments, and there is a more and more borrowing happening. In my mind, there are two reasons for it. One is that when the credit cycles are tightening, generally people prefer to take concentrated money deployment than giving it to the larger set of customers. In a way, take duration risk than a credit risk. So instead of giving a 3-year loan, 5 lakh rupees, they will give 10 lakh rupees for say 5 years. Instead of giving a 5 lakh rupees for 3 years, it is better to give a 10 lakh rupees for 5 years to one set of customers instead of finding two borrowers. So to deploy your capitals in more concentrated, high quality customers. So take duration risk. I come from bond market, so take duration risk than the credit risk. I think is the way the world will move towards. So I think that is one thing which is helpful. Second, even if we see the top quality indicators coming in for the top quality borrowers, those indicators are more or less intact. While only the time will say that whether they see some deterioration, because like what Presha said, margin of safety is also lower. Unlike us, where the margin of safety is high, when you lend at a 10-12% personal loan, your margin of safety is lower. So there you just need to have a little bit extra stress and you can get into trouble. But I don't see a large stress building out from there, because still there is a lot of demand for jobs. There are reshuffling happening, but yes, the craziness of 2021 has gone away in the tech markets, but I don't see there is a serious layoff. And given that next 1 to 2 years, at least from a broader economy perspective, I don't see any red lights coming up from the macroeconomic perspective. Having said that, I think one thing which every one of us has done in the past and continue to do is that there are pockets which are either over leveraged, which we are finding that there could be a potential risk out there, and consciously each one of us must be tightening, must be getting out of those little bit of positions, and which is happening across board. Again, going back to the CIBIL, they were presenting that approval rates on credit cards has fallen by almost 10%. From 30%, I think it is down to 20%, which is a big drop in a year's time. So I don't see that IT jobs or the more leverage is happening in the right set of consumers. It is one is broad basing has happened, which is good. But there might be always when there is a such a large growth happens, which has some element of structures and some element of overall availability, there will be some pockets which will expose. But I don't see a very very bad outcomes coming out of this cycle.
Ashish, I think that would be pretty comforting for a lot of our participants, because as we said, unsecured loan is also being given by fintech. And if we see in this panel itself, while this is a discussion on finance and BFSI, the panelists are coming from Pune, Bangalore, and Chennai. So none of them are from Bombay. So probably we as a set of stakeholders probably would be understanding the fintech industry lower than probably what our level of understanding should be. But having said that, that's very comforting that right action is being taken by the various players and moving ahead. And now my question is to Hemang, that the market perceives the fintech industry may face challenge when it comes to collections, especially during adverse market conditions. Is the fintech industry equipped to handle it? Given that many of the NBFCs have been growing the personal loan book through fintechs, how many of these NBFC partners are equipped to handle the collection in case the fintech player is not able to work out the way they should?
Sure. So effectively, there's there's a lot effectively these collection teams that the fintechs have hired, they are also from banks, credit card divisions. They're also from NBFCs. So the ecosystem is the same, and people, the talent that moves across on the collection side is also people who have done this for the last 10, 15, 20 years. And end of the day, so there's a set definition in terms of, or a process in which the collection process is handled. So you would want to, as part of collections, you want to maximize the return. So you would want to focus less and spend less time and money on cases where, even though there is a delay, but you have seen a track record that those customers have eventually paid. And you would like to spend more time, money, and efforts on customers where even the slightest of delay is a cause of concern. So, models have been developed. We have associate company, CredAvenue Spocto, who is specializing in this. So they have developed a big data model, which effectively says that you need to invest more time, energy, efforts into collection from this set of customers. And hence, our model is asking you to have a physical visit also, if required, on this set of customer, versus there is another set of customer where a simple IVR call or a SMS follow-up is good enough. Models, are also coming up, which are saying that, it is this between 3 to 4 p.m. is a good time to call Hemang for a follow-up on collections as compared to in the morning. Because that is the enriched data that is coming out from the demographics and the the background, the behavior of the person that is being seen by the digital lenders. So digital lenders are not only looking at financial data when they are onboarding, but they're looking at a lot of other social media data, which is helping towards this collection effort. So this ecosystem is evolving, and people are also trying to decide using this. See, this is all very large data, and on this large data, large set of collections, plus it is unsecured. So effectively, the roll forward rates will be pretty high. So if a person is 30 DPD plus, for that person to turn into 90 DPD is going to be more or less a given. So there is significant technology benefits that are coming out of this. A lot of vendors have set up shop on this side. So we are seeing, uh, you know, uh, a very specific and a granular collection strategy that has evolved. So fintechs, I would say that they are far ahead of the curve in terms of the collection strategies and the new age ideas that they have in terms of collections.
Right. Means it would be difficult for a person who is an outsider to the industry to understand the level of technology involved in collection and in being able to monitor each, let's say, the agent, each customer, and as you said, when to call. So, like we generally tell all the people that don't call care officials between 4 to 5 because they would be having a webinar at that point of time. So, yeah, but
Absolutely.
it's extremely technology intensive. So when we go to the collection room, it's surrounded by screens all across, and people are monitoring that. And I think that's a very good point that you brought out.
Absolutely. And it's not only collections, it's the whole, in terms of the disbursement, selection of clients, credit filters, there as well, the way I see it, risk is one part of it. But data science and big data is a larger portion of it. So models are teaching us in terms of what more we can do in terms of risk management, new clients, collections. So the system is also evolving in that sense.
Right.
I'll just add to this point on collections, to Hemang's point. I think also because most of the fintech lends for short tenors, their ability to risk manage is much, much larger because the behavioral scorecard plays a big part. Our ability, whether we should lend him again or not, is there. So it's not like a credit card. If I paid last time, I should be able to use this month. There are a lot of analytical tools has been built over a period of time, which allows us to really manage the risk very well. And second, from a collection perspective, there is a lot of tools has been used. But I think anybody who has been in this business for more than, let's say, who has seen COVID and after that, has inculcated whatever is traditional and improved it to make it better. So we have not given up on ensuring that we are making the required efforts to reach out to the consumers through various available modes. So all the traditional ways are still there, and we continue to improve on collection of data to ensure that we can do that piece. So the fintech is no more what we have 5 years back, only growth and they are not ability to prepare it. I think whoever has survived are all has built this piece very, very well.
Right, Ashish, because in all our discussions with our clients who are based out of fintech based lending business, everybody is talking of a collection team. Means this discussion was never happening 3 years, 4 years back. Means we always, the first concern we had that you don't have a collection team, you don't have a collection strategy. Now everybody is talking of a collection team, and the sizes, the increase in the collection team increase much higher than the increase in the technology team. So
that's true.
Okay. So again, Ashish, the next question is for you. Changing regulations have led to multiple operational changes in the industry. Digital unsecured personal loan has been gaining momentum and size, while the regulation is also evolving. This exposes the industry to the regulatory risk. What is your opinion about the regulatory risk and the policies in shaping this subsegment of lending?
So again, this regulatory oversight and regulatory environment is very, very perspective driven. Like what my perception will be very, very different than anybody else's perception. My perception about and my belief in the regulatory system is that regulation generally allow you to flourish much faster, purely from a fact that it's a clarity of what can be done, what cannot be done. And so after COVID, when RBI started talking about the digital lending guidelines, and when they came up with digital lending guidelines, it did two things. One, it has clearly articulated what can be done, what cannot be done, and really put it in place all the governance structure of LSPs and the REs and etc. The biggest benefit which happened after was the second circular which RBI came, which was again called DLG, but it is default loss guarantee, and which has actually gave a big flip to the entire ecosystem, saying that there is the capital arbitrage can be now narrowed, and you can actually access a large set of liquidity through the large partners. And what RBI is recognizing the fact that there is a capital sourcer and there is a customer sourcer and customer managers, and there is a merit in building a system and providing a system where the person with a capital and a person with the entire customer experience and the customer can create a joint partnership and ability to leverage both the sides. Otherwise, the fintech growth was getting constrained by the availability of capital, and which has created a very big flip to the providing the inclusion, reaching out to the next level. Like just while we can say that 78% of the loans are small ticket size, but at the end of the day, that money has gone to somebody, right? And that business is continuing to flourish. And that loans could not have been done without that technology or the algorithms which has been built by the fintech companies or the new age companies. So I think that recognition is a big thing. Of course, it also put a faith and responsibility on the fintechs to ensure that they follow it in the letter and the spirit, and that is what RBI intend to do it. So I think from the recent action perspective, RBI recognizes what we have built it. So I don't see any more industry specific action saying that the fintechs versus banks versus NBFCs. Of course, there is a good amount of RBI is asking us the data, and many of us has become now mid-size, and we have become very important part of the equation. So we will also learn. And we have learned, and many of us will learn to work within the regulatory environment. And regulators are also giving that kind of maturity to say that there is a new innovation which is happening, and we need to watch it and allow it to flourish. So both ways, it is at least last 12 to 18 months actions has shown maturity coming up in the fintech players also, as well as regulations are also becoming very clear. Of course, there are smaller issues always, but generally, I'm very happy with the environment which is developing the larger organizations and providing an enabling environment.
And I think just to add one thing, right? I think while, they've definitely, right, in terms of really, in terms of allowing the whole, how a fintech and NBFC can work together on the whole default loss guarantee as well. But I think the other very key thing that the regulator is also very particular on is really advocating for customer protection as well on this whole personal loan segment. I think for them, it's very important for the customer to be very clear, in terms of, what's the terms and conditions of the loan? What price is he exactly borrowing for? Is there any hidden charges? All that needs to be disclosed very clearly, right? So the regulator also wants to make sure that the customer knows exactly what is he signing for. And I think the second part of it, which the regulator is also, we've seen a lot of emphasis, is that there's no malpractice on collection and all as well, right? So, we joked about, 3 to 4 is a good time to call the customer, but you really cannot be calling post 7 p.m., right? There needs to be the right guardrails also in working there. So I think the way RBI is kind of designing it by allowing this whole default loss guarantee, we've allowed now for fintechs and NBFC to work together. But the idea is simple. We also need to champion the customer, ensure there's sufficient sort of protection for the customer, right sort of collection practices, and then each party knows your responsibility, right? And NBFC also today is under a lot of compliance burden, right? In terms of your complying to your outsourcing circular, IT circular and all, right? Because you have the license, right? So the regulator also wants to make sure you uphold that sort of responsibility that's been given to you also in that sense.
Right, Prisha. So we always used to think that RBI loves technology firms a lot, but I think they love the customer more than that. So I think that is the only point. Otherwise, yeah.
Absolutely, Sanjay. I think the customer comes first, the way Ashish and Prisha were saying. So there's this DLG guidelines. There's also this data privacy bill which has come out. So which is also helping in the longer run. These steps are really going to strengthen the confidence of various players in the market. That my data is protected, it is secure, it will be deleted after some time. So there are different things which are like falling into place, and it is giving clarity. So all the market participants want is that there is clarity, so that we can go about with the business in a particular direction, while taking care of the customer, because end of the day we are there because the customer is there. So taking care of the customer is important from our longevity and our business as well. Very important.
Yeah, Pressure is a very important perspective that these regulations are not just for fintechs, and they are also for the NBFCs, and to a larger extent, they are also applicable for banking system as a whole. So it's probably more of the customer accountability which RBI is exhibiting out here, rather than the industry gleaning or something like that. So again, Prisha, since you do fund a lot of these NBFCs and the assets directly also, so with assuming that risk keep building up in this asset category as a financial institution, what measures would have to be instituted to face the risk?
So I think, in order to kind of face this risk, right, especially on the PL side, I think there's a clear thought process on dividing into two parts, right? One is, I think, when you talk about risk, I think it's forever going to be a continuous loop. What I mean by that is, you start with underwriting, right? How do you underwrite? But the second point, which, we touched upon, is also how do you then price the risk, right? I think that's a very important factor in terms of determining, are you enough spread that you're going to have in everything. And then the third aspect is the continuous monitoring, right? So the minute you've dispersed the loan, what is the kind of early warning signals are you seeing? If you're seeing, a pattern, right? And, spotting the right patterns, right? In terms of any change in behavior, how can you then implement it back into your phase one of underwriting and ensuring then that the risk is managed, right? So the ability, I would say, for this continuous feedback loop among all of this is sort of critical. I think the other really key part on the risk segment is also really understanding, for a lending player, right? For us, especially because, we work with so many different partners, is really understanding the mode of how they acquire a particular customer. Now, with that also, that plays a big factor in seeing the customer's behavior. Now, for example, if a customer is coming through where its lending was embedded into a platform, right? So, for example, the customer was on a wealth management platform, and he was there to buy stocks, but lending was an ancillary offering that he took up. He will behave very differently to a customer that you source from an open market who's looking for a loan, right? So how you are able to also distinguish these different modes of customer acquisition, I think it's very, very important in also then from a risk framework. It's not just about what is the risk, but I think it's mainly about the who is the customer behind it to able to segment the risk, right? So I think that's very important because we work with so many partners, really understanding from each partner what's their channel, how do they acquire, as we then see like the performance, the risk and all also starting to come out as well.
Yes, so very right, Prisha. So you're saying that it's the acquisition of the customer where the risk assessment becomes most important rather than the activities after that. And even then, you'll have to keep your ears and eyes close to the ground and be aware of what's happening. So it's an involved activity where usually the assessment is once you go in a home loan, then you can sit tight and the money will keep coming back here. You'll have to be much more proactive and be in the market with the ears and eyes to the ground. Yeah. Correct. So there's a question probably Hemang can take here. We got from one of the participants that do personal loans of less than 50,000 rupees have higher SMAs and NPAs?
So it's there's no clear cut, there's no simple answer to this. Effectively, it depends on a variety of parameters. What has been, your bureau cutoff that you've taken as a minimum as a credit filter? What is the tenor? What is the demographics of that borrower? What is his income level? What is the geography he's living in? What is his salary? Is he salaried or self-employed? So various factors come into play, and the typical, the way to work with in this business is that you start off with a smaller ticket loan, say a 20,000 loan to a particular customer for a shorter tenor, say 3 months, 6 months. You see the track record, and once that track record has been built in your own system, you will be more comfortable looking at that customer for a slightly longer tenor. The way Ashish was mentioning, that you can look at a slightly higher duration for that particular customer. So there's no, one size fits all in terms of an answer to this one.
Okay, so now we have already crossed the time. So one question to each of the participants. So probably Prisha can go in first out here. So what do you see as the future trend and growth prospects for unsecured personal loan segment, given all the noise, the development, and the stakeholder movement which is happening?
I think at the heart of it also still, I think there is noise, but I think still continue to remain very bullish on unsecured lending, right? Because as I said, customer definitely is sort of looking for it, right? So I think it will continue to grow. But having said that, I think if you look out for the future as well, I think we will also see, more and more of, better underwriting models to go after new to credit segments, right? So I think that's an important sort of population. Today, they're probably about 15% in terms of the overall, customer that is getting a loan, right? So I think with sort of alternate credit models, we will see that improving. I think for the existing customers who have already taken a loan in unsecured, Ashish made a very interesting point, and I really echo with that, right? So someone like a credit card, you have a credit card and they don't increase your limit, right? So it's kind of like still a bit old school, and you might have had that same credit card for 10 years. I think what would be very, very unique is that we've really enabled a lot of sort of key capabilities in offering like instant loans, right? Digital, everything. But I think the next phase for like good customers, prime customers, is going to be a lot of personalized offers, right? So using that credit card example and all, I think something like a personal loan, right? It will be very similar today. Even customers like us, if we go out and take a home loan, we are looking for the best rate, right? Because we're saying that based on my profile, you can't give me a 8%, right? I should get a 7.8% because you should factor X, Y, Z in terms of thinking about how I get a home loan. So I generally believe that, given we've optimized a lot on the digital side for personal loan, I think the next growth in personal loan for the better segment is going to be a lot more personalized, customized offers, which really reflects the customer's true sort of behavior in order to get that kind of offer as well.
Okay. Yeah, Hemang, so given the noise and the trends which are coming out, so how do you see the unsecured personal loan doing in terms of growth and asset quality?
See, I think it's the growth is there, and we will see growth. We are also seeing that the co-lending is a big win-win. If you look at a fintech or a NBFC, access to liabilities or access to funding is often a constraint that drives your asset. So on the asset side, there is a huge demand, and there is scope to do more. Your models are getting increasingly sophisticated going forward. In fact, some of the models are saying that if the mobile number is starting with, say, a new series, say 77, and a mobile number starting with 77 might be a higher risk borrower as compared to a mobile number starting with 98, because that is a newer series. So there's a lot of demand now. on the asset side, on the liability side, co-lending is a big win-win. We at Vivriti are seeing a huge demand for co-lending in all the asset classes, not only consumer finance, two-wheeler, CV, MSME, MFI. We are seeing a huge demand, and technology has helped. The right people and the right processes have helped. So as long as we have a balanced view on that, we have a diversified book across customer segments, across different geographies. We should be able to manage the risks, but the growth is there on the asset side. It's just a question of how much liabilities in terms of the equity as well as debt that is available to this industry. And in terms of equity, while the markets are a bit subdued currently, but in terms of debt, co-lending is a big support. So RBI guidelines on this aspect has helped. The whole industry has evolved, and in that sense, it is turning into a more mature market now.
Okay. So Ashish has always pitched that data is the new security and the old securities are passé. So how do you see the growth prospects for the industry, and given all the regulatory noises and market participants' voices, etc.?
So it's always bad to be the third one to answer the same question. My father kept my name from A, thinking that I'll be the first one in Viva to answer the question. But anyways, so I echo with what Presha and Hemang said. The way I look at this industry of unsecured lending is that there is a big infrastructure has been built over last 10 years, digital infrastructure. Like today, a customer sitting, download my app, can complete the journey. I can pull account aggregators to get his accounts. I can do KYCs using the entire Aadhaar stack. I can do the UPI, e-mandate, and I don't need to really have a pen and paper or anything. I can do the entire activity on a mobile application, and which was never there. So I think we are going through a historical event where there is no precedent. Histories are there, but at the end of the day, there is a big change which is happening. And why people were looking for security in the past was purely because they were not sure of the data available for giving an unsecured. Now today the availability and the surety of data is so large that we will prefer to give unsecured. Because at the end, what is there? It means like I want to be sure that I'll get my money back. And there are ways where the data quality is improving and it's continued to improve. That's the first thing. Second, there is as soon as you put a secured lines, it becomes very friction. Whereas unsecured and the digital provides you a frictionless, and that's the people will continue to evolve and look at data very, very closely. So data becomes very, very critical to look at it. Third, more from a market perspective, I always go back and I've told this story many times. If you look at 2007, the microfinance industry was unorganized, or rather very, very small and unorganized. In 15 years of the time, microfinance industry, of course, there are tailwinds of PSL, there is a tailwinds of being inclusion, women focus, etc. But at the end of the day, that industry today, after all the political crises and etc., is today's 3.5 lakh crores. In 15 years' time, an industry has grown from nothing to 3.5 lakh crores, and which is highly unsecured in nature. And of course, there are processes which makes it tough to digitize, but there is a huge digital happening. But still, there is a big industry which has got built, which is unsecured in nature. And in my mind, there is no doubt that in next 10 years, there will be a much larger outcome on the entire unsecured, whether we talk about personal loans or SMEs. Yes, there will be an event which can happen. There might be companies who can come under pressure. There might be segment of borrowers who can come under pressure. But as an industry, as a country, I think we are on a path of becoming more and more data-driven, more and more digital experiences, and less about security of the thing. And second, if you look at the security, at the end of the day, home loans are only the secured asset in a true sense. So they will continue to have, because they are large ticket 20-year loans. But apart from that, more and more things will become digital. More and more things will become more on trust, and how do they really validate that trust? So I think that's the way the markets will play out over next 10 years, and you need to be there.
Right. Thank you. I think that was a very great answer. So thank you, Prisha, Hemang, and Ashish. So I now hand over. There are quite a few questions, but we're already 15 minutes short of the time allotted. So I'd like to hand it over back to our Divya to conclude this session. Divya, can you take a place?
Thank you so much, Sanjay, for moderating this session, and Nikhil for your presentation. We would once again like to thank all our guest speakers for their insightful views. It was indeed a privilege to host you. Lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedbacks, or suggestions, please write to us in the feedback mail. Goodbye for now. Wishing you all a happy and a prosperous Diwali. Request the tech team to kindly log out.